How do public banks compare to development banks? Have you ever wondered how public banks stack up against development banks? Both types of banks play important roles in our economy, but they serve different purposes. Let's break it down. Public banks are owned by the government and offer a wide range of banking services. They provide deposits, loans, and other financial products to the general public. Their main goal is to support public policy objectives like financial inclusion and economic stability. Unlike private banks, public banks focus on serving the public interest rather than just making profits. They often aim to keep operational costs low, reflecting their commitment to public service. Public banks can help with wealth distribution by offering affordable credit and financial services to communities that are often overlooked. This aligns with socialist principles, which emphasize equitable resource distribution. By making banking services accessible, public banks play a role in reducing economic inequality. On the other hand, development banks are specialized institutions created to fund long-term projects that promote economic development. These projects can include infrastructure, agriculture, and small-scale industries. Unlike public banks, development banks do not typically provide regular banking services like deposits or withdrawals. Their focus is on financing specific initiatives that may be too risky or long-term for commercial banks. Development banks use government funds, bonds, and external borrowings to support these projects. They take on higher risks by investing in underdeveloped areas or sectors, aiming to stimulate sustainable economic growth. They also encourage private sector participation in development projects that align with public interest. When comparing the two, the scope of services is a key difference. Public banks serve the general public with a variety of banking services, while development banks focus on funding specific development projects. Public banks prioritize financial inclusion and public welfare, while development banks are all about long-term economic growth. In terms of risk, development banks assume higher risks to support projects that have social and economic benefits. Public banks generally engage in more traditional banking activities with lower risk. Funding sources also differ. Public banks relying on government capital and public deposits, while development banks use government funds and borrowings aimed at development financing. Both public and development banks support socialist goals by promoting equitable access to financial resources. They direct investments towards social welfare and economic equality. Development banks particularly embody socialist ideals by financing projects that address structural inequalities. In practical terms, public banks are tools for redistributing wealth through accessible financial services. Development banks serve as strategic instruments for directing capital to socially beneficial projects that might not attract private investment. Together, they are essential in a socialist framework, ensuring that financial systems contribute to reducing inequality and supporting collective economic progress.